What's up guys, Zain Elias here from Nordic Investing, and I wanted to do kind of a brief video about the Q1 reports of American banks that came out last week. And I've summarized the more interesting information that came out, and we're taking a look at 4 big banks. Those are Goldman Sachs, Morgan Stanley, Wells Fargo, and Bank of America. What we can see from these reports are that there are some trends that we're seeing across all American banks and perhaps throughout financial institutions in the world. So perhaps these banks are kind of setting the stage up for what we can expect from other financial institutions. So let's start with taking a look at Goldman Sachs. We can begin with viewing the highlights and see that the firm actually reports revenues of $17.7 billion, more than double the amount in the first quarter of 2020. They also reported record quarterly net earnings of $6.84 billion and record quarterly diluted EPS of $18.6 per share. They also report 31% return on equity, which is quite a good result considering that it's a large bank. Goldman Sachs further reports that in the investment banking segment generated record quarterly net revenues of $3.77 billion, including record equity underwriting net revenues and strong net revenues in financial advisory and debt underwriting. So this pretty much means that the global economy, or you could also say the economy in America, is recovering quite strong, which then gives the bank more business and more traffic. The global markets segment generated quarterly net revenues of $7.58 billion, which is 47% higher than the first quarter of 2020, and its highest quarterly net revenue since 2010, reflecting the second highest quarterly net revenues in equities and strong net revenues in fixed income, currency, and commodities. So with the rebound of global markets, Goldman Sachs, and this is the trend for many banks, they have made quite a substantial amount of money when stocks and certain securities actually gained a 100% return from the bottom of 2020. Also, Goldman Sachs report that $3.15 billion of capital to common shareholders during the quarter was returned through $2.7 billion of share repurchases and $448 million of common stock dividends, which is quite rewarding for the shareholders of Goldman Sachs. So a further description on net revenues, Goldman Sachs reports that the increase compared with the first quarter of 2020 reflected higher net revenues across all segments, including significant increases in asset management, global markets, and investment banking. So simply due to the rebound of the economy, Goldman Sachs are breaking records in revenues and earnings. So in a description in the investment banking segment, Goldman Sachs reports that net revenues was due to significantly higher net revenues in both equity underwriting, primarily driven by strong initial public offerings activity. So this simply means that more businesses are becoming active, and which signals higher economic activity with mergers, acquisitions, higher amount of IPOs. We're seeing more economic activity in the United States. Oftentimes, what happens in the United States kind of echoes throughout the world, especially in Europe. Looking at operating expenses, we see an increase of expenses in 2021 Q1 compared to the Q1 and Q4 in 2020. However, Goldman Sachs report an efficiency ratio of 53.3% compared with 73.9% in 2021. That is 1 year before. So there are different efficiency ratios, and I do not really know which one they're referring to here, but it's normal that efficiency ratio is calculated by taking the operating expenses divided by revenues, and a good ratio is around 50% and under. So we absolutely see a huge improvement comparing 2021 and 2020. In the financial statement, in March 2020, the net revenues were $8.7 billion, which has increased in December last year to $11.7 billion, and now in Q1 2021, we see that the revenues reached $17.7 billion. So we can see here that a lot of gain in revenues came from market making and investment banking. This might be a sign that this year is the year of stock investments, especially since markets in the United States and Europe reaching record levels, which is of course somewhat expected in a low interest environment where stocks are the superior investment. Looking at net earnings, we see an increase to $6.8 billion compared to the same period in 2020, with earnings at $1.2 billion, which is approximately the quadruple the amount in March 2020. If we take a look at the first headline in the Q1 report of Morgan Stanley, we see increase in revenues and earnings in line with other American banks. The revenues of Morgan Stanley increased from $9.8 billion in the same period of 2020 to $15.7 billion in this quarter. If we look at the summary that Morgan Stanley provided in their Q1 report, we see that the efficiency ratio for Q1 2021 is actually quite high at 67%, which is a little bit on the higher side compared to, for example, Goldman Sachs, which reported 53% in efficiency ratio. Another interesting metric to look at is the return on equity, which landed at 16.9%, which is of course higher compared to Q1 2020, but still on the lower side compared to other American banks. The investment banking segment reports revenues up 128% from a year ago. That is from $1.1 billion to $2.6 billion. So the theme here for American banks seems to be a huge increase in revenues in the investment banking segment. Again, with higher economic activities comes higher volumes of IPOs and other types of offerings, which contributed to an almost 5-time increase in equity underwriting revenue. This could be a sign that 2021 will be a good year for stocks in general and perhaps growth stocks in particular. An interesting event worth mentioning that occurred with Archegos Capital, where Bill Hwang managed his family money, saw a huge loss when Archegos defaulted on margin calls. Morgan Stanley and Goldman Sachs were affected in this event. I recommend you checking out Patrick Boyle's video about this event. He makes a really detailed explanation of what happened here. Looking at the financial statements of Morgan Stanley, we see an increase in earnings per share compared to 2020 Q1 and Q4, which is in line with other American banks and the world economy. We should also notice the fact that the amount of employees have increased drastically comparing Q1 2021 and 2020. So in just 1 year, Morgan Stanley increased the amount of employees with a little north of 10,000 employees. This could be seen as a move that Morgan Stanley is equipped for a global recovery. If we now turn our heads to Wells Fargo, we see a different story compared to the other banks. First off, we see a return on equity at around 10%, which is a little bit on the low side. Also, the efficiency ratio landed at 77%, which simply means that even in this time of global economic recovery, Wells Fargo is not as money effective as the other banks we've looked at so far. Now looking at the income statement of Wells Fargo, we see that the net interest income has actually gone down comparing this year to last year. This could be explained by the lower interest rates, which was triggered due to the global economic situation. Low interest rates do affect banks negatively. So far, Wells Fargo is the only bank that have reported a year-on-year decline in net interest income, compared with Goldman Sachs and Morgan Stanley. Here we can see Goldman Sachs net interest income at $1.4 billion. And here we can see Morgan Stanley net interest income at $2 billion in this quarter. This could indicate that the other banks are a little bit better at managing their loans compared to Wells Fargo. However, looking at net income, Wells Fargo managed to increase earnings compared to Q4 2020 and of course Q1 2020, which is in line with other banks. Bank of America, which is one of Warren Buffett's more beloved holdings. In the Q1 report of 2021, Bank of America states that net income sees an increase in the consumer banking segment, which reflects an improved macroeconomic outlook. This is a trend that we see over and over again, looking at the other banks. However, revenues are down compared to the same period in 2020, due to lower interest rates. We stated before that low interest rate environment do affect bank earnings negatively. However, this could be offset by higher loan volumes, which becomes tricky because you still need to maintain a good balance of high loans to credit-worthy individuals and businesses. The competition between banks becomes tough. If we look at the balance sheet, we see a trend for many banks where total deposits have gone up. That is, people are holding more money in banks. The reason for this could be the stimulus checks that have been given out being used either for investing or for holding in banks, waiting to be used for everyday living, though deposits usually is recorded as a liability on the balance sheet. Banks actually benefit from high deposits because these deposits could be used for further investing in bonds, for example. Loans, on the other hand, have gone down as expected, affecting interest margins negatively. We see this trend in American banks where money is being made in the markets rather than in interest on loans. Many individuals and businesses are suffering economic consequences due to the pandemic, which then makes it hard for banks to find creditworthy individuals to loan out to. Thus, we see a decrease in total loans. There are of course more banks such as JP Morgan Chase and BNY Mellon, and I do encourage you to take a couple of minutes to take a look at the earnings if you are interested in these sorts of financial data. We try to provide you with that information here on this channel so you can get access to that information easily here. So to summarize how banks are doing so far, banks are making money due to the market gains, but are making less money in interest due to the low interest rates. The global economic recovery have so far contributed to higher revenues and higher earnings. However, no one really knows for how long this economic recovery will sustain, but for the time being, banks are looking pretty good. Thanks for watching, guys. I'm Zain Elias and this is Nordic Investing.